Thank you for joining us today in this webinar. I'd like to start off by thanking the amazing team at Bitstamp for putting this all together today. We've all been reading and talking about all the events that have been unfolding over the last couple of weeks, and it's really great to have this forum to be able to talk about it. My name is Alyssa Ostrov. I'm the Chief of Staff for Crypto Compare. We're a market data and index provider that offers digital asset data and index solutions to corporate, government, and retail clients. As a data provider, we've put in a lot of research and focus on the digital asset exchange ecosystem, and with particular attention to what we witnessed over the last couple of weeks. I'm joined today by some amazing panelists, so I'm going to introduce in just a few moments. Obviously, it's been quite an unprecedented couple of weeks in the crypto industry. As you all know, FTX, one of the largest crypto exchanges, went insolvent and filed for bankruptcy protection. Unfortunately, this has devastated the many firms and individuals who had their investments stuck in the exchange and caused a domino effect on many industry players. It's a situation that's still unfolding by the day, and I'm pretty sure is going to make a fascinating Netflix movie at some point. But rather than take this hour to hash out everything that's happened, we really want to use today's session to reflect on some of the lessons that we're learning and really some of the industry best practices that will let us rebuild from here. Today's webinar is about trust, regulation, and transparency, and what we can expect from the industry in the coming weeks and years. I am joined today by Jack Ellers, who is the COO of Bitstamp, Michael Roberts, the head of Prime at Copper, Thomas Restout, the CEO of EMEA at B2C2, and Henrik, I'm not sure I said that correctly, but I did my best shot, the co-founder of Thalex. So I'd now like to introduce my panelists to just give a brief intro of yourselves and your firms before we get started.
So my name is Jack Ellers with Bitstamp. Thanks, Alyssa. No, it's great to be here and have this conversation. It's really important to have this dialogue. With Bitstamp, I'm general manager for the European business and also for the group, the chief operating officer. With Bitstamp, we're one of the oldest running exchanges, right, in the crypto space. So we've been through, many of these market ups and downs, but it seems like each new one sort of takes it to a new level, right? So it's good to have this conversation going. Thanks.
Yeah, hi everyone. Mike Roberts, very happy to be here also. I head up Prime Services at Copper. Spent 25 years on the sell side, building and then running Prime brokerage for one of the top tier Prime brokers out there. Excuse my voice is a little bit rash today because of a cold, so forgive me if I drop on the call.
Hello, I'm Thomas Restout, and I'm the CEO for EMEA at B2C2. Similar to my peers, I've been on the TradFi side, on the sell side for many years at Goldman's and Morgan's, running various electronic businesses. I've been one of the first investors at B2C2 and finally decided to join B2C2 to help it navigate one current market, but most importantly, strengthen our leadership position in the OTC space. What's B2C2? It's a market maker, or we provide liquidity to clients directly, only B2B. And as much as it's difficult to see market as it is today, we pride ourselves to provide continuous and tight liquidity throughout all type of markets.
Yes, and I'm Henrik. Thanks for having me. I'm co-founder at Thalex, which is a new crypto derivatives exchange. It offers options, futures, and we also focus on combinations of derivatives. We've just gone live in October, and now we're busy on our road to market strategy, working on partnerships with exchanges, as well as getting licensed in Gibraltar. And prior to Thalex, I've been involved in private equity and venture capital, and spent the previous cycle on the investment side in crypto businesses, including Bitstamp.
Awesome. Thanks all. Just a bit of housekeeping. We will be taking Q&A throughout the session. So I've set aside sort of 10 to 15 minutes at the end. We hope we can keep it as interactive as possible. There is a sort of Q&A box that you should see at the bottom of your screen. So if you do have questions for our panelists, feel free to just drop them in there. I'll be monitoring them throughout, and then we'll hopefully get to as many as we can. So I'd like to kind of start off just addressing the first topic of the panel, and that is the issue of trust. This industry has definitely made it through our fair share of trust impacting events, from Mt. Gox to this year alone, Terra Luna, Three Arrows Capital, the breakdown of a number of lending firms, now FTX. Certainly from a consumer perspective, if a liquidity crisis can occur on an exchange like FTX, why can't it happen at other exchanges? So as the longest running digital asset exchange, I'd like to start with Jack on this. How can we begin to regain the trust of consumers on the back of what we witnessed over the last couple of weeks?
Yeah, thank you, Alyssa. Well, it's going to take time. That's for sure. I mean, everything that you mentioned, these are major, company and market failures, and it's part of an industry that's sort of growing and changing and very dynamic and also very complicated. It's not going to be easy. All of us, on the call, I think are affected by it in some way. Some of the things that have come to mind for us in the last 10 days at Bitstamp is that we know that customers have to know that their crypto is safe, right? That where they hold their crypto, they understand how it's being used, how it's being secured, and they want greater transparency, visibility into knowing that whoever is holding it has it. The other thing is that there's going to be a lot more scrutiny of the companies that I put my crypto in or I put my money in, just the same in the traditional space. I want to understand what their business model is. And I might not get as deep into, the kind of internal controls that they have, but I know on the corporate side, institutional side, those questions are going to be asked more and more, right? To really build the trust on the institutional and corporate customer side. And then for sure, I think we're going to be expected to give greater disclosures to customers, to investors, on what they're putting their money into or their crypto into. And we're going to talk about it later in the discussion here, but a lot of this probably going to mirror what we see in traditional finance, right? I mean, these things have been built up over decades. And maybe just quickly, the last part is probably more regulation and supervision. We're going to cut the investors, retail and corporate, are going to expect some kind of supervision of someone holding my money or my crypto, holding me to a high standard of how I operate my business, and far more scrutiny, into the details of things.
No.
Yeah, Thomas.
Maybe I'd like to insist on one point that you made, and again, the fact that you were one of the oldest digital exchange, I think 2011,
right?
And for B2C2 2015, which kind of makes us old in the digital aging scale, but
Yeah.
I'd like to make a comment on trust, not how necessarily how we regain it, but first of all, I think we've missed out on the June, July type of events, which gave us large alerts on trust already, and trust came back pretty fast in the market. That's my personal opinion. The fact that we had an event in July and yet again one in September, well, actually November, sorry, was first surprising to me, and now we're taking steps that we should probably have taken before. But I think the most important point for me is time. Even when you think personally where you would leave your money, forget digital assets, you feel it's safer with a bank that has existed for 300 years or 200 years, really long period, than a new bank that's just out on the street that looks fancy, that looks great. And I think people make it's this analogy, I think, resonates more to people because it comes to managing their fiat. And I think trust is built over time. That's why Bitstamp probably is a trustworthy place. That's why I think B2C2 also demonstrated above and beyond anything we're going to do in the future, that trust can be given. It's not something we will we've acquired in 5 minutes, and it's not something we will regain in 5 minutes.
Jack, I think you raised some great points on just the question of kind of risk management. And I think as, you know, more and more details have unfolded about FTX, it was, you know, it's increasingly clear that there was sort of an obvious lack of adequate risk management tools that were in place. And obviously, you know, while traditional finance has had centuries to develop and prioritize these tools, regulatory frameworks to reinforce them, you know, the digital asset industry is quite immature in comparison. So starting with Thomas, but really open to all of the panelists, what are some of the risk management measures that you have in place or are potentially going to change going forward?
Again, I'd like to make a quick anecdote. We already started saying that TradFi was kind of the mecca on how you actually manage risk. As we're going to go along this panel, I hope I will be able to refer back to very recent event that happened in TradFi that had disastrous consequences and that rely on exactly the same thing as what happened to FTX. And maybe I'll start, for example, with Archegos, which last year did cost the banks $5 billion. So certainly not a small amount of money. And that resembles very closely to what happened with FTT used as a collateral. So I really hope that we can learn from TradFi, but let's not stop there because they still repeating the same mistakes over and over again, and they have certainly not cornered the inherent risk of the markets. As far as we are going, that's our job to do risk management. We're a market maker. We, by definition, we take risks. So maybe I'll give like 3 or 4 categories of high risk that we have, for which we are happy to share metrics on how we do, and even again, not necessarily on with broad audience, but we are happy to discuss in quite specific terms with our clients. Obviously, market risk, which everybody sees as the unique risk, I actually see it from my risk as almost the smallest one of them. But of course, when you're a trading house, this is the risk that you manage all day long. And here we have tons of metrics around how much risk we're allowed to take. That's for each trader, each asset, each derivatives type. And that's probably the easiest one to understand. The second one is exchange risk, obviously more topical because of FTX. Thank you. In this case for us, there's all the work you can do to increase your certainty that you're putting your money in the right place, but there's always a risks. There are always a risk that you take. And what does that mean for us is we have very strict limits on how much exposure we can have to a given exchange. I don't think it's fairly public today, but we also, as B2C2, got caught on FTX, not with Alameda, not on FTTs because we don't trade that, but we had money on FTX to perform our business. So did we lose money on that exchange? Yes, we did. Was it within our risk appetite? Yes, absolutely. We actually lost less than a maximum risk that we would be willing to take against FTX. Does that put our business into a difficult position? Not at all. It was planned. It's part of our business that we could lose that amount of money to a given exchange. Not that we wished for it, but we were kind of ready for it. So exchange risk or exchange exposure, credit exposure is one risk that we manage and take. Same goes with our clients. We take an amount of risk against our clients. Now, risks that are probably more important for people who trade crypto today, again, as an example of failure at FTX, is our liquidity risk. We have, again, very strict measures as to how much inventory we carry so that we can make our clients good at any given time. We have very specific metrics. 70% of all our transactions or settlement needs to happen within 15 minutes, 99% within the hour. We need to have 80% of our liquidity back in cash within 1 day, 100% within 2 days. So all those scenarios where people need their money back today, right now, they're always covered. This is part of our risk management. And we have other risk, reg risk, algo risk. I mean, I can go on to all the buckets of risk, but I'll save that for another time. I'll say one thing that one last thing, because before I hand over, there's also concentration risk at the management level. We have seen at FTX that a very small number of people could basically do anything. Within firms like ours, and certainly like B2C2, governance is key. I don't get to do anything that I want, fortunately or unfortunately, but governance is key in firms to prevent misbehavior like we've seen. We have a chief risk officer. All the risks that I've outlined before, he sets the limit, not traders. You cannot be judge and executioner. Otherwise, you'll always be tempted, shall we say. So again, I'll leave you with that. As much as we have a lot of risk and we're happy to share how we manage them or numbers around them, governance remains the key in any firm.
Yes, do you mind if I chime in here from a copper perspective? Because copper's a custodian, so we're not an exchange. And some of the risks that were just talked about, we have a solution in place called ClearLoop to allow safe custody trading from custody. And then some of the risk controls we have around that is, the assets that are held in safe custody, the initial margin that Copper protects on behalf of clients and exchanges is also risk monitored by a risk team 24/7, 365. We margin call exchanges to top up the P&L accounts for customers. And we've been battle tested on this with a couple of exchanges that either had hacks or unfortunately had holes in their balance sheet over this period of liquidity issue. So I think there are solutions out there. The market needs to kind of, unfortunately go through some pain to realize some of these things have a value to them. But, as the market evolves and matures, there are things out there to negate some of this risk. Also the point on policies within firms, because it seemed to be very wanting at FTX. Copper's well known for its policy engines. So we have policy engines that allow, hedge funds, market makers, etc., to segregate duties, just like B2C2 do. So there is a lot of technology plus knowledge and know-how in this industry to get things right. I think we need to come together as a collaborative partnership to kind of do this in the right way. Everyone talks about the absence of regulation, but best standards and best practice are there. And if we move away from trying to own the whole vertical and become like a dominant firm in crypto and think about best practice and partnership, I think we can come out of this in a far better way.
Absolutely. And I definitely want to kind of dive a bit deeper on some of those points that both of you have raised on governance and on regulation. Henrik, I'm curious to know, have your views of the market sort of changed as a result of what we've witnessed over the last couple of weeks? Do you think traditional finance institutions are going to be more reluctant to enter the space now?
Well, view on the market is that there's a lot of capital that's been destroyed, and then there's a lot of capital that has to delever, and then there's a lot of capital that has to de-risk. So in any case, in the short term, there's just less available to actually engage in trading. And a lot of exchanges are now talking about how they're all relatively well positioned, for instance, because they're regulated or doing other things. But I think in an absolute sense, it's going to be harder for everybody for a while. And we still haven't seen the full extent of potential contamination, right? So one fraud gets exposed, and then there's a lot of other people that get exposed on poor risk management. and that will take time to play out to see the full extent. And that I think is certainly something where new institutions looking at the space, they'll also be hesitant, right? If they haven't been convinced to enter crypto yet, now they've gotten actually a lot of additional reasons to be skeptical. But I think the extent to which this then does lead to reform is ultimately what actually could be interesting to create, let's say, a path for new money to come in. I mean, if you think about 2022, it's been a stress test on many parts of the infrastructure. Now we're stress testing exchanges as to whether they can actually meet withdrawals. We're stress testing stable coins as to whether they can redeem. So there's also a lot of like new data points you can actually plug into the risk equation of what you're doing. And then to some extent, there's potentially more opportunities. I mean, if you think about, just take Ethereum, for example, I mean, it's not investment advice, of course, but you can ask yourself what should drive the price of Ethereum in 3 years. Is it the fact that they had a successful merge, or is it that an exchange blew up? And I think on a fundamental basis, the former should have more impact than the latter, but the price certainly moved a lot more on the recent exchange-related events. So I think to the extent that the infrastructure can regain trust, there will be more institutional options. But for a little while, there's just capital that's been destroyed or inactive, and that's going to take time to rebuild.
Anyone else want to weigh in here?
Yeah, just maybe one thing on the. I also think like we are. This market is very emotional. So right now we are almost at the worst time. Everybody wonders, questions the existence of crypto. Is this system going to survive? Who's next to go down? These are the questions that are being raised. But nobody said that they would have been dying to buy at those levels 6 months ago, let alone 12 months ago. If you were a believer 12 months ago, or a believer not in the religious sense of the term, like you have strong belief of the utility of this industry and what it can brings, well, nothing has really changed fundamentally besides destruction of values and a few bad apples being weeded out. So I'm looking forward to, probably until the end of the year, I'm pretty sure people will be thoughtful and observing rather than anything. But I'm actually more on the optimistic side that right now they're great levels. They're great levels to buy distressed asset. They're great levels to reinvest. If you are on the VC side and you haven't allocated your money, well, valuation came down so much that now you can actually afford. It's a great time for consolidation. So you'll see a lot of players absorbing other players. And it's a great time to reinvest. Again, people were buying Bitcoin at 65,000. How about that 15,000? How about at 12,000 if it goes down? It goes down again. Unless you never believed in what you were investing at in the first place, then I hope the mood will change reasonably fast, and we'll see it as an opportunity rather than a collapse of the entire ecosystem.
I agree with Thomas, and in the comment you made on it's not about the technology so much as it is about a few of these sort of bad actors within the industry, right? That have sort of had bad practices. I mean, we have a service called Bitstamp as a service where we offer this to traditional financial institutions who want to have an engine behind for their customers to trade crypto, right? To get into that space. They're probably more cautious and maybe more skeptical about moving into that now. But what it is, what they're more looking at is who are they going to do business with in the future, right? What are the standards of those partners that are in crypto that can provide the technology, that can provide the operational part of it, and be confident in that. Right, so that's what I see on the main thing with traditional finance in terms of the exchange services that we can offer. They want to make sure that they're doing business with the right partners.
Some excellent points there. I'd like to just switch gears a little bit here. I think one of the key issues that the situation has raised has been the digital asset market infrastructure. And unlike traditional finance, where roles and responsibilities between participants can be much more clearly separated, I think those lines in crypto are sometimes a bit more blurred. One of the things that ultimately resulted in the downfall of FTX was this bundling of products and services under this one sort of massive conglomerate. And you had this highly complex web of companies that clearly, even accountants and auditors were not fully able to untangle. So I'd like to start with Michael on this one. Do we need to revisit the segregation of responsibilities in the industry? Is it better to emulate the sort of traditional finance model where we have a custodian clearly looking after funds, exchanges, bringing buyers and sellers together, everyone really able to focus on the areas that they do best?
Yeah, I mean, I think to answer this question, if we want to drive institutional adoption, we need to think about how institutions fund themselves, how they invest, the protections they need to provide. And, hedge funds raise their assets from pension funds. They raise their assets from sovereign wealth funds. These types of structures have expectations, they have responsibilities. And, when they raise money to invest in any asset class, the rule 101 of a hedge fund is to protect the principal, you should hedge the principal and then provide upside. The crypto ecosystem is very unique in that it grew up needing exchanges to pre-fund, and it's understood why that happened. But there are different ways to do this so that we can give institutions confidence. There's a just separation between church and state. So yes, I do think we need to look at segregation of duties. I think we need to do that if we have ambitions for institutional money to grow and allocate in this space. The buy side needs choices. The buy side will never trade with one trading desk in traditional finance, use one prime broker, use one custodian. It's immature of our space to think that one firm is going to rule everything. The buy side will not allow that. So I think it is the opportune moment for us to think about what we do best, what we don't do best, the separations, what gives our clients the confidence to move forward, and then that allows this ecosystem to grow.
Anyone else have any thoughts on this?
I'll take the other side for the sake of argument for a second. Within the TradFi industry, just pointing out that most of the names that you have in mind, they have strength, but they also have global coverage of product. If you take the two biggest custodians of the planet, which are probably BNY and State Street, they both have an investment bank. So I don't think it's incompatible, but in both cases, they have rules of engagement between their different entities. Again, I'll only talk about metrics that I know for a fact, but when I was on my prior jobs, which in a bank that had a very strong investment bank and a very strong asset management bank, there were rules of engagement between the two. Segregations of assets, segregation of credit. You're not allowed to trade more than 10% of everything you do as an asset manager with the investment bank to which you belong. So I think the very easy way to approach it is to say custodians will be custodians, investment bank will be or market makers will be market makers, and they will never be one and the same company. But I think the most important is defining the roles of engagement. What we don't want, to go back to FTX, is like not only there were lying about the nature of the relationship, but there was no limit to what one could do with the other. And that was the problem. It wasn't that they were one and the same company, the problem. It was the nature of the relationship and the non-Chinese wall between the two of them. That was the real problem. Because I'll make one last comment for users. The more you have to fragment your usage, your vendors or counterparties or custodian, the more expensive it becomes. If you need 10 custodians, 10 market makers, 10 PBs, everybody needs to be able to survive in this market. So it becomes extraordinarily expensive for users if we don't manage to create synergies between the various functions.
I think we keep coming back to this sort of general point around governance. There's such a clear argument here that there should be, some kind of mandatory governance structures in any sort of crypto venture that is involving client assets. In the case of FTX, we had these sort of highly opaque corporate structures that were used to, quite possibly enable fraud, and a lack of transparent corporate governance definitely made it much more easy for that to be perpetuated. Jack, I know Bitstamp takes very much a sort of traditional finance approach to its governance structures, but can you sort of touch on what governance looks like and means to Bitstamp in a bit more detail?
Yeah, thanks, Alyssa. I mean, governance it's a broad term, right? You don't have to be regulated to have good governance, or even be regulated to have bad governance. Now, as Thomas mentioned before, there are a lot of companies with probably pretty good governance who also failed, right? Who also didn't, maybe made some bad choices. But they had a structure in place to try to manage the risks that they were accepting. And going back to also the point made earlier about risk management, at least when you have governance within the company, you're being more deliberate, you're being more intentional, you're accepting the risks, at least that the known risks that you're moving into. So for a Bitstamp, I would say that we started our licensing journey back in 2016 as a payment institution, right? It's not a little certificate we just sort of pin on the wall. I mean, there are real obligations behind this. And the scrutiny that we have with our regulator, right? So that drives that kind of governance on how we do risk, how we do compliance, how we do legal, how we do accounting, how we do internal audit, and the others. The other part of governance for us is also just defining our business and setting boundaries, right? Back to Thomas's point, it's up to this certain limit, and you will not go beyond that. We're using governance as a way to set those boundaries for our business, where we go in and out, and it's across not just that small group, but from the investor to the board member to the managers down into employees. Setting standards from policy, from licensing, and I would also say just on the decision making. Keeping good records. We're reading recently about some of using some of these tools where there's this auto delete kind of function, at the end of a message being sent out. That's not the way to run a properly governed business. Yeah, and not the way that we do it, or anyone on the call here. So governance is a big topic. It's something we can continue to improve on. We're not perfect. No one is, but it's essential. Yeah, it's essential to have that kind of a mindset.
I mean, you made the point that governance can happen sort of with or without sort of clear regulation in place. And we have a lot of firms really building out governance structures in the absence of regulatory clarity in this field. I think one of the arguments on the back of what we've seen really is that the lack of regulation is responsible for a lot of what we have witnessed. And I guess I'd like Henrik, if you don't mind, to tackle this one first. Is regulation the answer here? And if it is, how can we sort of strike that balance to make sure that consumers are protected, but we're still enabling some growth and innovation in the industry?
Well, I mean, the challenge of regulation is that it's local, and crypto business is global, right? So the first way that regulators, if they want to actually strike that balance, the first thing they got to do is actually have more companies under supervision. And there's, let's say, a negative path by enforcement, and there's a positive path in terms of supervision that should also act as prevention. I think the enforcement path, we've seen this in China and then in the US, it just ultimately leads to displacement, right? These businesses and these customers and these assets just move elsewhere. On the other hand, if let's say it is more accessible and more important, if it's more efficient and fast to actually get licensed, that could be more of a carrot instead of a stick for businesses to try to actually create viable alternatives to non-regulated counterparts, where then you can benefit from the investment in trust. Now the problem is that a lot of these regulatory tracks, they can take years to actually get licensed, and especially if you want to do something in for instance, derivatives or complex products beyond spot, sometimes you require multiple licenses. And the time to get licenses takes so long that by the time you actually are at the end of that process, your innovation is outdated and you have no customers, so there's nothing to balance. So it actually creates a situation that is quite ironic right now, and we'll see how this changes now after FTX. But the equilibrium that the market has set into is sort of a state of maximum irony, where regulated exchanges like Bitstamp are used as just an on-ramp to go from fiat to crypto, then trade on unregulated exchanges. And paradoxically, those exchanges, they've had such a high return on investment in a way by betting on, asking for forgiveness rather than permission, that they now have so many resources, they're actually pretty well positioned to invest in regulated structures. So it's quite paradoxical, all of it. But I think the key to it has been that just the upside of getting licensed, the positive of regulation, has been too inefficient. And we need, regulated businesses to be able to compete on product with unregulated businesses.
Absolutely. I think all interesting points that will hopefully get more clarity on as regulation becomes a bit more clear. Will be very interesting, certainly in the EU, to see what the effects of MiCA are on the industry, among a number of the other sort of broader regulatory frameworks that we are seeing increasingly come into play. I think another area I'd like to touch on really is this question around transparency in the industry. Proof of reserves and liabilities have become very important topics of discussion. Based on data from our last exchange benchmark report that we put out last month, only 6 out of 133 exchanges had carried out a proof of reserves in the last 4 years. Obviously, that is just one form of transparency, but I think this is something that really has formed a narrative on the back of what we've been seeing unfold. But I'd like to open, to all the panelists. Maybe Michael, you can kick us off here. What are some of the measures that you are all introducing to try to increase transparency and regain some investor confidence? And what can we do overall as an industry to make sure these are actually really cemented in place and into practice?
Yeah, I mean, look, I think it centers around a couple of things. You mentioned proof of reserve. I mean, we're helping the exchanges that we have connected to Clearloop to demonstrate proof of reserve for the buffers that they have with us to collateralize their business. We're seeing a big push from the exchanges to connect to Clearloop to demonstrate to their clients that, that split between trading and, custody. So, I think those two things come together to, solve a big part of the problems we faced with FTX. I think it's quite public that FTX made an announcement that they were going to join Clearloop and then subsequently didn't. Clearloop is all about protecting client assets. So, we probably can make some judgments about why that didn't happen. It's very disappointing to us. We didn't want this to be the case, but it was. So we are, we had the product. We're expanding the product with the exchanges we have to demonstrate proof of reserve, client asset protection, etc. I think some of these practices are going to be cemented through 2 ways. The buy side's moving, the traditional buy side players, and I delineate a little bit between crypto native buy side firms and traditional buy side firms. Crypto native understand the space a bit better. They have a higher understanding and risk tolerance. the traditional players that we want to come into this space are now driving a different agenda and a different bargain with everyone in this space. And if we want them to maintain what they're doing and grow in this space, we are going to have to make it look, whether it's right or wrong, a bit more like traditional finance. So the buy side's pushing that. I think we can come together as an industry to do it. And then if we don't do it, I think regulation's going to fix all this, with the FTX problem. So, that's how we view things. That's how we're trying to push things. And we very much see it as a partnership to try and make the space better.
Absolutely. Anyone else want to weigh in? Jack, is sort of proof of reserves and liabilities something that Bitstamp is looking at now?
Yeah, just as Mike said, we've been spending a lot of time on it even before things happened 10 days ago, but we want to. It's more than just proof of reserves to us. I mean, we're trying to really look holistically on how we should be presenting this to our customers and keeping them updated, and who's also doing the audit and doing giving the proof, right, of reserves, whether it's on the asset side, the liability side, etc. So we're trying to take a holistic view of that, and we also want to do it with an audit firm, right? I mean that really knows what they're doing, and really is making a commitment to this. So it's something that over the next 4 to 6 weeks, for sure, we want to have available to our customers. So there's proof of reserves through that audit. There's like a Nansen dashboard that we've also been looking at, or some kind of miracle tree. These types of things, depending on the kind of technical, sophistication that our customers have, what they're interested in, we want to be sure that we can offer that, and then continue to keep it updated, right? And really offer this as a service. So it is something that we will be spending a lot more time on. Yeah.
That's great news, and I'm sure will go a long way to help the kind of question of regaining trust that we spoke on earlier. I think just looking back generally now, sort of in hindsight, and hindsight's always 2020, right? Were there any red flags that we very clearly missed here? I think, much of the industry felt very blindsided by the FTX collapse, but if so, how can we sort of avoid similar situations unfolding in the future? Thomas, maybe you want to kick us off here.
Oh, we knew all about it. To be fair, I think it was shocking, because if you ask my personal feeling, like FTX was one of the highest regarded place to trade by many respects. You looked at the cap table, you look at the regulation, you looked at the success, the volume, so the credibility of the business model. There were so many reasons why FTX looked like a safe place to trade and to be leaving some of your coins or money.
Mm-hmm.
What in hindsight, what were the alerts that we should have been receptive to? Well, one, Alameda. Here I'll cite our founder, Max Boonen, who loves to tweet about his stories with Alameda, but for a long time we had ceased relationship with Alameda, not necessarily because we thought they were not credit worthy or because they were funneling money, just because we did not see eye to eye on how to make money in those markets. We saw ourselves as a liquidity provider. Our job was to oil the market when coins are being exchanged. They were using dubious strategies that have been seen times and times again in traditional finance to make money, and we didn't think this was suitable. So we had no more trading relationships with Alameda. Doesn't mean we saw what was going on at FTX. FTX, I think in hindsight, people should probably have been more thoughtful about the value of an FTT coin, for example. What was it relying on? How come there was like $9 billion worth of FTT? And when you think that the only thing that was actually bringing was like fee discount on the exchange, for example, looking at metrics such as what was the concentration of ownership of those FTT, because that was almost public. If you did a bit of homework, you would have seen that most of it was held by single individuals. Again, I mentioned Archegos. This is exactly what they've done. They went 1.5 billion. They bought a capitalization, small cap capitalization. They used those, they pumped up the stock value. They used that stock as collateral to trade with the top tier bank, Goldman's, Morgan's, Credit Suisse, you name it, leveraged themselves like crazy. And one day it all blew up. Exactly the same story. And that was last year in TradFi. So this is quite hard schemes to figure out. Alerts would be, they had 300 employees versus 6,800 employees at Coinbase, similar revenue, similar business model. That's a red flag. Think about it. That's $30 revenue per head. That's hell of a business. But that should definitely have raised eyebrows. And lessons learned. Again, it's not because you had the best hedge fund at the cap table that they had done a good job. They've all seen the balance sheet. They've all seen the balance sheet. Nobody raised an eyebrows. So it's not that obvious to see it. We should just be more cognizant that it's not because it's been endorsed by others that we should endorse it in the same way. And probably my last point before I hand over is, no matter how much confidence you have in exchange, make sure you have a risk policy, because you can never be 100% sure.
No, all very good points there. One of the metrics that the Crypto Compare Exchange benchmark actually looks at is the number of employees to the trading volumes, and it's quite interesting to see that as a point of comparison.
Thanks for the heads up.
The word is out. Just a quick one. I want to leave time. We're getting some awesome questions coming in through the Q&A. But I'd like to just ask all the panelists, and if you could sort of keep your answers as brief as possible, under a minute. Where do you see this all playing out? Markets, trading venues, how is this going to evolve in the next 5 years, and what part is regulation going to play in that? Buyer's choice, who kicks off?
I can start. It's hard to say over 5 years, really. Maybe over the next 12 months or so. But there will be the investigation, right, into what happens here, and I think that will drive on the enforcement side, right, and probably scare a lot of people about taking these same kinds of steps in the future. I mean, that's what enforcement is sort of about, is getting the bad guys, but also making sure that people understand that if they're going to do fraudulent behavior, or maybe not even intentional, but just wrong things, and it's against the law, then they're going to be taken to justice. So on the regulatory side, in the EU, we do have coming up, but then not for another 18 months, or longer. So there's still some time, but we're going to have a sort of a change in the industry, and I think in how people are looking at each other and wanting to know who they're doing business with. That will be the biggest thing, I think, in day to day. It'll be due diligence across the industry and really trying to understand each other. Mike.
Yeah, I tend to agree. I think the industry will be smaller for a period of time, more paranoid. It will probably help in the longer term to set things up in a smarter way. I agree with everything you said. The biggest point that I think was obvious from Thomas's summary earlier, it's governance, it's mind and matter in these seats. The obvious thing when you look back on it now was, there was far too little, mind and management sitting in those seats at FTX, and I think that'll be a focus for all the firms across the industry now.
Henrik?
Yeah, if I can jump in. So I think you can't look out 5 years. I think what you can do is try to position strategically for like a range of acceptable outcomes. And so, for instance, on the regulatory side, it's really something where I have no idea. could very well be that it takes a very long time for actually regulation to come into play and then be reinforced so that the current offshore-onshore equilibrium sustains. Or there could be, there could be scenarios where essentially all the major crypto exchanges that are unregulated today will have a very tough time of existing in the next 5 years. And so it's very hard to actually take a directional view there. What we do at Thales is we actually have a strategy where we call a regulatory straddle, where we get licensed with stablecoin set of derivatives in Gibraltar, and then later on we'll have a look at MiFID and see whether we can add fiat settlement as well. And then when it comes to questions around evolution, the interesting questions are more like what's not going to change, right? I think DeFi is here to stay. I think continued sophistication of and efficiency in, let's say, especially major coins like Bitcoin and ETH will continue to happen. It's obviously my partial view that derivatives will make crypto more efficient, and then there needs to be new exchanges and new trading firms that make derivatives more efficient. Those are things that are not going to go away.
And from my side, I think we've taken a couple of step backs, and now we're back to answering fundamental questions. Is my money safe?
Right.
Can I retrieve my money? Will I have liquidity to transact? And those questions, there were questions that people were asking themselves in 2019 and before, probably prior crisis. And now we sent ourselves, Sam sent us back into those into answering those fundamental questions. What will be the answer? Is this rebuilding trust? For sure. Will it be transparency? Will it be regulation? Will it be solving exploit and hack on DeFi because trust is already solved there? What is the path that this ecosystem is going to take to answer those questions and get investors' confidence back? There are multiple. But what's for sure is right now we're back to square zero. Very fundamental questions, and we need to answer them fast.
Thank you. Thank you all. I'm mindful that we're almost at the end of the hour here. We've got a lot of awesome questions coming in through the Q&A. So I'm hoping we can rapid fire through as many as we can. First one appears to be for Jack. Does Bitstamp see an influx of new customers because of the current troubles and other exchanges, or is the market as a whole decreasing?
It's not a rapid influx of new customers, right? But it is because generally across the market, people, as we said earlier in the call, people are still sort of cautious about where they're going to move their crypto business, right? So, but our view is that yes, in the short term, over the next 3 to 6 months, people are going to reposition themselves, whether they're on the corporate side or the retail side. And Bitstamp, our exchange as a regulated long-term exchange, is in a very good spot to take those customers and serve them well, right? So we're at a point of people are still cautious, not making that decision, but we think over the next 3 to 6 months, you're going to see that kind of a movement, and Bitstamp's in a good spot for that.
Right. We've got another question here, sort of touching on some of the points we discussed earlier. Are there any entities that have become too big and interconnected that they could pose a systemic risk for the crypto space? For example, crypto banks. Anyone want to tackle this quickly?
I mean, from the crypto bank perspective, look, we need a bit of a diversification. I think the industry, the grown-ups in the room, and I count everyone on this call as grown-ups in the room, we'd like to see more banks providing banking services to the industry. The fact that there's, concentration amongst a couple of banks is no good in any industry. So, hopefully one of the things that comes out of this unfortunate sequence of events is that we can have a more robust and better banking service. It creates interconnectivity that maybe these banks didn't want in the first place, but were forced to do things to facilitate the business that if there were other players in the room, they could diversify the risk and share the product suite. So hopefully that's something that it solves itself in the longer term.
Awesome. Here's a spicy one. If any of the major stable coins like Tether or USDC collapse, how will that affect exchanges and markets alike?
I think I'll take this one because I wanted to it's a good follow up on we need more banks, because the reason we need more banks is because the fiat rails are still pretty poor and fiat is still key to crypto trading today. Most of the people who are invested in crypto still lives in fiat land, and those rails need to exist. So we need diversification, because if there are no banks, we cannot actually process fiat transaction. The ecosystem cannot prevail. Which is a good segue to what has been the largest use case for stable coins so far, both of the US dollar stable coins. It's actually facilitation of transaction. This is why we can guarantee 15-minute settlement transaction even on a Sunday afternoon or on Thanksgiving, for those who will celebrate Thanksgiving. So they are actually key. So let alone the amount of money that would be destroyed if one fell, it would be a massive hit for the crypto industry, because those rails will disappear.
Here is a nice one. I think for everyone, might be a wrapper depending on time here, but maybe we keep answers super brief. What do you each see as the biggest opportunity for your business given recent events?
I mean, on our side at Copper, I mean, we have seen a big influx of clients and exchanges. You know, we have a different business model. You know, ours is about safe custody, and we've had the product in the space. So, you know, out of unfortunate events, you know, we are busier than we've ever been. Volumes through Clearloop are as high as they've ever been. So, look, we expect someone else to copy and provide a similar service to Clearloop, and we see that as a badge of honor, because the industry needs to grow, it needs options, etc. So, you know, that's the, I guess, the tailwind for our business that's coming out of this.
Yeah, and along those lines, I mean, we see this as a once in a decade opportunity, right? To really regain the retail and corporate customers that we have that have gone to these offshore exchanges in the last 5 years. So we really see this as an opportunity for us to regain those retail and corporate customers.
I will echo that path. For us, we're seeing a return of clients who had left us, and a massive influx of reverse inquiry. I'll leave you with the numbers. Since FTX has gone down, we see a 30% increase of our unique users and 100% increase of client pipeline on our side, and this is just business to business, so not the retail side of the conversation.
Yeah, and I'll just quickly add that you know, as an exchange, FTX actually did a lot of things great in terms of catering to institutional and also advanced trading features. So as much as you know, on the risk and governance side, clearly they were efficient, they also really built great product, and I think you know, other exchanges should also take lessons from what they built and succeeded in, actually.
Awesome. Lots of great insights here, and lots of food for thought as we move forward and try to rebuild from this. I think we are just about at the end of the hour. I want to give a big thanks to Bitstamp for bringing us all together here today. Awesome to be able to discuss this here. And thank you to all of our panelists. Do you guys want to just quickly let everyone know where they can reach you if they have any other questions after the panel?
Yeah, bitstamp.net, and John Ehlers on LinkedIn. Mike?
Same, LinkedIn, or reach out to copper.co, and we're happy to help.
b2c2.com, you'll have everything you need.
My part, Talix.com, LinkedIn for me personally, or Talix Global on Twitter.
Awesome. Thank you all so much. We'll leave it there. Bye, everyone.
Thanks, Elisa.
Thanks,
Thank
Elisa.
you. Thank you. Thanks, everybody.